Let me show you something quietly insane that's happening right now. Something so big that every investor, every pension fund, every future retiree is already part of it. Yet almost nobody realizes. If you have a 401k, if you invest in the S&P 500, if you buy index funds because it's safe, then whether you believe in AI or not, your money is already betting everything on AI. Because today, almost 40% of every dollar you put into a basic S&P 500 index fund goes into just 10 companies. Not 500. 10. NVIDIA, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, JP Morgan. This is no longer diversification. This is concentration disguised as diversification. And in the middle of that concentration sits a single name, NVIDIA. Right now, NVIDIA alone absorbs almost 8% of every new dollar that flows into the S&P 500. When you think you're buying the market, you're actually buying the AI dream. A dream so powerful that it has added trillions to market caps, pushed stocks to record highs, and created the illusion that growth is unstoppable. In 2025, AI giants will spend an estimated $330 billion on data centers, GPU farms, and computational infrastructure. But the part nobody wants to say out loud is this. To justify their current valuations, AI leaders would need to generate $2 trillion in annual revenue. $2 trillion every year. For perspective, Apple, Amazon, Microsoft, Meta, Google, and NVIDIA combined still don't make $2 trillion in revenue today. The market is pricing AI as if it will outperform every tech revolution in history. It will generate more wealth than all current tech giants combined, and it will happen fast enough to justify today's valuations. It's not optimism, it's expectation on steroids, and the expectation is already creating distortions. Sam Altman recently announced that OpenAI is prepared to commit $1.4 trillion in future spending. Not billion. Trillion. When asked how a company making around $20 billion could possibly fund that, Sam snapped. He brushed off the numbers. He dismissed concerns. He joked that if early investors wanted to sell, he'd find a buyer on Twitter. Behind the joke was a truth. Don't worry about the math. The story will take care of itself. But stories don't build data centers. Stories don't generate profit. Stories don't pay debt. And that's the problem. Because this entire AI miracle isn't being paid with profits. It's being paid with debt, and not the kind you can see, the kind that hides. In private credit, in SPVs, in joint ventures, in off-balance sheet commitments, in circular financing loops that make revenue look bigger than it really is. You are not looking at organic growth. You're looking at a feedback loop. NVIDIA invests in OpenAI. OpenAI buys compute from Microsoft and Oracle. Microsoft and Oracle buy GPUs from NVIDIA. NVIDIA reports booming revenue. NVIDIA reinvests into OpenAI again. It's the Three Stooges IOU skit, but with trillion-dollar companies. And because these companies dominate the index, their growth, real or artificial, pulls the entire market upward. It makes the U.S. economy look strong. It makes investors feel safe. It makes the boom look inevitable. But what investors don't realize is this. To stay valuable today, these companies must borrow from a future that doesn't exist yet. And that's exactly what scares the smartest investors alive. Warren Buffett is quietly selling billions. Michael Burry is shorting 80% of his portfolio against NVIDIA and Palantir. Deutsche Bank says the U.S. economy would already be in recession without AI spending. All the signs are there. But almost nobody wants to connect them. Because what happens when a story becomes too big? Not just to ignore, but too big to fail. That's what we explore next. The most dangerous illusion in this entire AI boom is that the growth looks organic. Investors look at NVIDIA's revenue, Microsoft's cloud numbers, OpenAI's scale, Amazon's data center expansion, Google's AI integration, and they say, see, real demand, real growth, this is different. But the truth is more complex and far more fragile. Because this growth is not being driven by profits or productivity or stable cash flow. It's being driven by circular financing, a loop where money moves so quickly and between so few players that it looks like growth. But in reality, it's the same dollars being reused to justify bigger expectations. Let's break it down. At the center of the AI economy sits NVIDIA, the world's most valuable chip maker and the only company capable of producing the GPU supply the entire industry depends on. Here's the loop, as simple as possible. Billions of dollars flow from NVIDIA model builders. OpenAI signs massive multi-year cloud contracts with Microsoft, with Oracle, with Google Cloud. These contracts are enormous. Tens of billions committed up front, even before the revenue exists to justify them. Microsoft and Oracle interpret OpenAI's demand as growth, so they buy even more NVIDIA chips. Wall Street reacts. AI is unstoppable. Buy more. The loop starts again. Money, compute, GPUs, revenue, reinvestment, money. From the outside, it looks like demand, growth, adoption, profitability. But on the inside, it's a closed ecosystem passing the same dollars around to amplify valuations. This is why critics call it the trillion-dollar echo chamber. And here's the part that makes it even riskier. The S&P 500 is market cap weighted. That means the bigger a stock becomes, the more of your index fund it occupies and the more money flows into it automatically. NVIDIA rises, index buys more NVIDIA. NVIDIA rises more, index buys even more NVIDIA. This is not analysis, this is math. The AI boom and passive investing have formed a perfect loop. Circular financing pumps valuations, valuations pump index weight, index flows, pump valuations, valuations pump index flows. The loop feeds itself until it doesn't. Deutsche Bank recently released a statistic that should make every investor pause. If not for AI-related spending, the U.S. economy would already be in a recession. That means GDP growth, stock market performance, job creation, earnings stability, corporate investment, capital markets confidence all hinge on AI spending continuing at full speed. If Microsoft reduces CapEx, if Amazon delays a data center build, if cloud demand slows, if corporate budgets tighten, the loop breaks. And when a loop breaks, it doesn't slow down gradually. It unwinds. Let's address the strange outlier in this whole story. Bitcoin. Tech stocks are going up. AI is exploding. Gold is at record highs. Corporate earnings are stable. So why is Bitcoin declining? Two forces shape markets. 1. Technical force. Bitcoin recently broke below its 50-week moving average. A historic line that separates bull cycles from cool-down periods. Technical traders follow rules, not stories. When the line breaks, they sell. Enough sellers, IL's trend becomes reality. The macro story is deeper. Bitcoin is the canary in the coal mine, the first asset to react to liquidity stress. The Fed ending QT early should be bullish, but investors read it as a warning. If the Fed is stopping QT early, something may be breaking. Bitcoin reacts first. Tech reacts later. The real economy reacts last. This happened before. Bitcoin cracked before the 2022 crash. Junk bonds cracked before the 2008 crash. Small caps cracked before the dot-com crash. When liquidity weakens, the weakest markets react first. Bitcoin is simply telling us liquidity is tightening. And when liquidity tightens, bubbles tremble. Another crack in the system is showing. Some of the earliest, largest holders of tech assets are quietly exiting. Sovereign wealth funds, early VCs, model developers, private equity players, crypto billionaires, legacy tech insiders, they're all doing the same thing. Reducing exposure, building cash, taking profits, waiting for a reset, reducing leverage. Why? Because they've seen this movie before: the internet in 1999, housing in 2006, crypto in 2021. Early money never rides the bubble to the top. Only retail does. When insiders exit quietly while retail piles in loudly, that's always a warning. Let's zoom out. The entire AI explosion rests on constant expansion of cloud infrastructure, unlimited corporate CapEx, stable liquidity, circular financing, passive inflows, geopolitical pressure, investor belief, and the assumption that growth can continue vertically, but none of those things are guaranteed. A slowdown in just one of them breaks the entire loop. This is why Buffett is sitting on more cash than ever. This is why Burry is short. This is why Deutsche Bank is cautious. This is why Bitcoin is flashing liquidity warnings. The loop is magnificent, but fragile. The story is big, but unsustainable. And the future depends on whether spending can grow faster than reality. We explore that next. Here's the truth about bubbles that most people misunderstand. Bubbles don't end when valuations get too high. They end when the story breaks. Because in Fin, what happens if the story slows down? Let's break down ending 1. The hard pop, the worst case CE. This is less likely as be ending 2. The slow deflation, the most likely outcome. This is how most bubbles die. Slowly, quietly, painfully, expectations cool, corporate spending slows, cloud growth flattens, AI excitement fades, GPU demand drops from explosive to merely high. Valuations compress, stocks drift sideways for years, passive inflows weaken, investors lose interest. Innovation continues, but profits don't. This is exactly what happened in the dot-com era. The internet did Beck ending 3. This is the ending nobody talks about but government what T. This is the part where other YouTubers give cheap advice: just keep buying. No, the truth is simpler and harder. 1. Don't F narratives. 2. Don't chase exponential chiff always co. 3. Own the future, AI is real. 4. Hold K cash is not dead money. Cas 5. Avoid leverage. 6. Let dividends pay you while. 7. Buy when fear is where wealth is built. Because here's the real secret: the problem is not the AI bubble. The problem is thinking the AI bubble.